Hey gang, it's been a wild start to the week. The S&P 500 fell more than 6% over Monday and Tuesday. There's no doubt the coronavirus fears sparked the sell-off, but the intensity of the sell-off had more to do with how overbought most stocks were, something I've been warning you about for a few weeks now. This shouldn't come as a surprise. As I'll get into today's video, markets desperately needed this pullback. It's normal and totally healthy. Stocks are bouncing today, but the question on everyone's mind is whether this is a dead cat bounce or a start of a fresh rally. To get some insight on that answer, I'm going to review an often ignored index. Let's jump into it right now. Folks, what you're seeing now is a map. It's not a heat map per se. It's a capitalization weight. Now, why are some squares or circles or whichever shape the size of these shapes are, why are some bigger than others? Why is Google this big and why is IBM this big? Well, that's a good question. The answer to that question is market cap, and more market cap. Some of you may know this, some of you may not know this, but the S&P 500 has 500 stocks, but they don't all have the same say. They don't have the same vote. Some are big bullies, while others are very, very small. So don't think of as the S&P 500 as a capitalized weighted index of 500 stocks. It's just not the case. You've got 500 stocks, but if I take Google, Microsoft, if I take Apple, if I take Amazon, I could probably fit all of those other squares or rectangles into those boxes. I mean, look at the size of Microsoft. It's got 2.61% market cap of the entire S&P 500. If you take Apple and Microsoft together, you've got over 5. Two stocks make up more than 1% of the index. That's huge. So again, put Amazon, put Google, put Facebook, put JP Morgan, Visa, and a couple of others, and next thing you know, you've got the control of the index. Now, why is this important? It's really important because what if a stock like Apple goes up, but 30 little stocks like CSX, Charter, UPS, FedEx, these are massive companies, but they're small in comparison to Apple, just because Apple is so darn big. So what if Microsoft, Apple, Google, Amazon, and Bank of America and Visa went up and the rest went down? You wouldn't see it as a 5 stocks going up and 495 going down. You may see the stock market barely wobble because of the strength and the share size that these stocks have. And that's one of the biggest downsides to the S&P 500. It doesn't give you a clear representation of how big the companies are in it or which ones are influencing it the most. It's a major issue. It's not a small issue. Think about it. 5 stocks, 6 stocks, a handful of stocks could be dictating the entire S&P 500. Now, before I get you too worried, most of the time, say 75% of the time, it's just not that big of a deal. Why? Because all the stocks move in the same direction. The ocean moves, the waves move in the same direction. It's all moving together. But there are times when capitalized weighted indexes can give you a very distorted picture of the market. For example, this is the S&P 500. Right now, we've had the 2 biggest down days in, I think, the Dow Jones's history. The coronavirus is hitting everybody around the globe. There are several thousand deaths, and things are bad. And one of the first barometers we would look at in the S&P 500 for a sort of a safety zone, a buying zone, a bounce back zone, is going to be the 200-day moving average. That's this mustard-colored line right here. And as you could see, the S&P 500 is nowhere near there. The S&P 500 is trading near 312. The 200-day moving average is at 304.52. But let me show you something interesting. This is the non-capital weighted S&P 500. This S&P 500 takes all 500 stocks in the S&P 500 and it gives them equal weighting, equal footing, makes them all the same. Takes this graph here, takes these shapes, and makes them all the same size. It's interesting, right? Because the ultimate thing is you got to look at a pool of the biggest stocks. You can't just look at five. Five stocks will huff and puff, but those 495 others will move the market. Well, if you look at the equalized weighted index, where every stock gets an equal share, no discrimination, no bigger, smaller market cap, you will see that yesterday it actually touched the 200-day moving average. What do you know? That's a very significant indication that we are now possibly bouncing. And guess what? Today, we are bouncing. We're not doing great, but we're off the 200-day line. And a lot of investment bankers, institutional traders, they use momentum levels that are based on market internals. Like I do. When you're looking at market internals, you're looking at the market from this perspective, not this perspective. So again, if you're just looking at the S&P 500 externally, and if you're not taking the market cap into account and looking at it from this perspective, you're seeing this chart instead of this chart. Very, very different data. As a matter of fact, totally different data. So it's very important to look at assets with an equal weight. Let me show you another example. And again, this is only relevant when markets are making big moves, like the last few days. For example, the Russell 1000. And just so you know, the ticker symbol for the equal weighted S&P is RSP, where the regular one is SPY. So let's look at the Russell 1000. Why are we looking at the Russell 2000? Because the Russell 1000 doesn't limit us to 500 stocks. It limits us to 1,000 of the biggest stocks. Gives us a bigger group. But here's the problem again. It's a capitalized weighted index. So while the capitalized version of the Russell is here, if you look at the Russell 1000 that's not capitalized weighted, that has equal weight, equal EQAL, it's already below the 200-day moving average. Now, sometimes the capitalized weighted index is more important. Sometimes the non-capitalized index is more important. But what's really important is for you to recognize and use both as a perspective. Because if you're not seeing the market clearly. You're seeing the market like this instead of like this, or like this instead of like this. Now, these are, in theory, the exact same indexes. This is the S&P 500, and this is the S&P 500. But the only difference is market capitalization. One is giving you a market capitalized version, and the other one is giving you an equal weighted version. And the difference between the two can be the difference between being above the 200-day moving average and being below the 200-day moving average, or having 5 stocks give you a lot of exposure versus the overall market. So please, 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 whenever you're looking at the index and you're looking at a technical chart, please consider the market cap of whatever you're looking at, because it can completely, potentially distort what you're looking at. Folks, even if you expect a pullback, let's be honest, it's almost impossible, virtually impossible to time it to the exact date or even week. You never know when the stock will fall. That's why I always encourage traders to use hedges, trade diversified assets, and use prudent stops. But another way to decrease the risk is to minimize the time you spend in the markets. Think about it. In other words, get into a trade before a large move occurs and quickly get out. And there's one trader that made a career out of these 24-hour trades. He deciphers data from the option markets to strike the moment the stock will jump or crash. Even though the trades are short-lived, these gains can be in the triple digits. He's about to go live with the strategy. You can get all the details by following the link below. Do it now. You'll regret it if you don't.